There is a market that has posted double-digit logistic rent growth for 4 consecutive years, where warehouse vacancy has hit the lowest level ever recorded, where e-commerce is growing at nearly 17% annually, and the biggest platforms on the planet are spending billions just to keep up. It is not United States, it's not Germany, it is not India. It is Brazil. And the global logistic community has been chronically systematically underestimating it. The Brazil logistic market reached 127 billion in 2025 and is projected to surpass 172 billion by 2033. Logistics absorbed 12.6% of Brazil's GDP, far above the 8% global mean. That tell you two things simultaneously. The market is enormous and the inefficiency gap represents a massive opportunity for whoever moves first to close it. Today, or logistically speaking, I am taking you inside the numbers, the infrastructure bets, the technology bet, and the structural forces making Brazil the most compelling emerging logistic market on the planet right now. Average rental prices for high-end logistic warehouses in Brazil rose from $3.7 per square meters in 2020 to $4.9 per square meter in 2024, with Class A plus asset near Sao Paulo and Rio already trading at $7.4 to $7.8 per square meter. Then came 2025, and according to JLL, the normal average rent hit $5.6 per square meter, 11.6% increase year on year. In Sao Paulo specifically, it reached $6.16, a 17% jump. By year end, Sao Paulo's average was trading above $6.68 per square meter, with premium asset touching $8.71. 4 consecutive years of double-digit growth. In a market of this scale, that is not a spike. That is a structural repricing. Gross absorption or demand in Q1 2025 alone hit 1.1 million square meters, the highest quarterly absorption in 4 years, while net demand exceeded new stock and the vacancy rate hit 7.9%, the lowest ever recorded. Only 28% of Sao Paulo's current inventory consists of modern logistics space, and the construction pipeline totals less than 1% of existing stock. You cannot build fast enough, and that is precisely the opportunity for logistic companies where demand will exceed supply for years. To understand why demand is so structurally robust, you have to understand what is happening in Brazilian e-commerce, because it is unlike almost any other market right now. The market is expected to reach $69 billion in 2026 and climb to $150 billion by 2031 at a CAGR of nearly 17%. And the growth is not being driven by one platform. It is a full spectrum arms race. Mercado Libre deployed $6.4 billion in logistic investment in 2025, doubling its Brazilian distribution center footprint, and introduced 10,000 electric delivery vehicles which can operate free of restrictions in cities with mobility constraints, unlocking same-day fulfillment for 40% of Sao Paulo orders by mid-2025. Amazon have expanded aggressively, reaching 250 distribution centers in Brazil in 2025. Logistic companies are expanding space to support this growth, like Seva, who has already opened 67,000 square meter Amazon fulfillment center near Brasilia, capable of supporting up to 135,000 packages daily, and plans of expansion to 620,000 square meters of contract logistics space across Brazil by 2028. This is not competition, this is land grab. No discussion of Brazil's logistic opportunity is complete without Sao Paulo. Greater Sao Paulo has a population of 30 million people, a GDP of $625 billion, and a per capita income of $21,000, and accounts for 35% of Brazil's entire industrial production from just 3% of its land area. It is home to the port of Santos, Latin America's busiest container port. As land in Cajamar and Guarulhos tightened, logistic clusters began migrating westward towards Jundiaí, Capinahas, and Embu. Logistic parks are expanding along the Castelo and Raposo corridors as the inner ring reaches capacity, while Minas Gerais is emerging as a second-tier market of genuine scale. The first movers took Sao Paulo's inner ring. The next wave is Minas Gerais, Rio Grande do Sul and the Northeast. The curve is still early. The single largest structural constraint on Brazil's logistic ambition has always been port efficiency. And for the first time in a generation, that constraint is being actively dismantled. The Santos Port Authority has launched a massive modernization plan that includes deepening the navigation channel to allow 18,000 TEU mega ship to dock for the first time. This initiative would help Santos Port reaching 7 million TEUs capacity by 2026, which would expand to 9 million TEUs by 2028 after the DP World investment expansion completes. A digital twin technology, a virtual replica of the entire port, enables real-time monitoring and scenario simulation. Santos' real-time berth occupancy system has already cut idle time by 8%. Beyond Santos, Brazil's Ministry of Ports unveiled a plan encompassing over 50 initiatives with projected inflows of over $3 billion across this sector by 2027. In Pernambuco, the Sope port deepening has made it Brazil's deepest public container port, capable of handling Suezmax tankers and 366-meter container ships. Expansion of port facility in places like Santa Catarina, Natal boosted grain exports and reduced logistic cost. This is not a single project. This is a national port transformation happening simultaneously with the warehouse construction boom. There is a macro force accelerating everything we have discussed, and it has nothing to do with Brazil's domestic dynamics. The global supply chain reconfiguration triggered by US-China trade tensions, COVID disruption and the ongoing Middle East disruption is pushing multinationals to ask a question they have deferred for decades. Should we diversify away from single region concentration? Brazil is answering that question more compellingly than almost any other emerging market. It is the world's largest producer of soybeans, coffee, sugar and beef, a top 5 producer of iron ore and ethanol. Its agriculture sector accounted for nearly 49% of the country's $164 billion in export in 2024. And it has a 7,500 kilometer Atlantic coastline directly facing both North America and Europe. The nearshoring dynamics are compounding. For companies diversifying away from Asia-concentrated supply chains, Brazil is not just an option. In many categories, it is the only option at scale. This is a part most observers miss entirely because they assume emerging markets equal legacy infrastructure. They are wrong. Mercado Libre's electric vehicle deployment make it one of the largest electric last mile operation in any market globally. Amazon's automated fulfillment centers cut pick and pack times by 30%. Dark stores operators like iFood and Rappi are pushing 2-hour delivery outside Tier 1 cities. And Family Mart's AI route optimization system shaved 10% of routes and 20% of kilometers while maintaining freshness windows, a case study in how AI in logistic technology is being deployed not in Silicon Valley but in Brazil convenience logistics. The sustainability dimension is also becoming a market differentiator. Legislation on infrastructure debentures with zero withholding tax is drawing ESG-focused investors towards LEED certified logistic asset. DP World's Santos terminal has already eliminated over 1,000 metric tons of CO2 since electrifying its rubber-tired gantry cranes. Brazil is not catching up with the developed world in logistic technology. In several dimensions, it is overtaking it. Any credible analysis has to confront the real challenges because they are significant. Only 12% of Brazil's federal highways are in good condition. Freight averages 40 km per hour on intercity corridors. Vessels' wait times at Santos can stretch to even 10 days. And the tax structure, multi-jurisdictional, constantly evolving, add cost and unpredictability with no parallel in developed markets. And the truck driver shortage is acute and worsening. And elevated interest rate make debt-intensive development more expensive. But here is a counterintuitive insight. For sophisticated investors, many of these challenges are features rather than bugs. They suppress new supply, which is why vacancy rates keep hitting record lows. They create barriers to entry that protect first mover advantages. The challenges explain why the opportunity exists. If Brazil were easy, the premium returns would already be arbitraged away. The institutional signal is unmistakable. Heinz sold a portfolio of 4 AAA logistic warehouses totaling 328,000 square meters across Manaus, Rio de Janeiro and Cajamar to XP Asset for $213 million, one of the largest single logistic real estate transaction in Brazilian history. This is not speculative capital. This is long duration, income seeking institutional money treating Brazilian warehouses the way they treat toll roads and airports. Prologis, the world's largest logistic real estate platform, has directly invested in Sao Paulo and Rio for years and describes Rio's market as significantly undersupplied with demand still catching up. The Brazil logistic real estate segment is projected to grow at a 7.69% CAGR between 2026 and 2031, the fastest growing slice of the entire commercial real estate market. Brazilian REITs, known as FIIs, are now primary vehicle for both retail and institutional access to this growth. Infrastructure debentures backed by zero withholding tax legislation are pulling long-term capital into new development. And build-to-suit contracts with the e-commerce and 3PL tenants are becoming the dominant development model, securing long leases, eliminating speculative risk and delivering the stable cash flow profiles that institutions require. The capital is here, the demand is here. The supply constraints guarantee the returns. Brazil's logistic real estate rent growth surpasses the global average by more than 500 basis points. Class A vacancy rates are set to fall to mid-single digits. With a construction pipeline totaling less than 1% of modern stock, market conditions could remain structurally tight for years to come. Brazil has 215 million consumers. E-commerce penetration was 3% in 2017, which is now 11% and is heading towards 24% within this decade. A $127 billion logistic market that absorbs 12.6% of GDP, which means every efficiency gain is extraordinarily valuable and an opportunity for logistic companies. Pix, Brazil's instant payment infrastructure, is one of the most advanced in the world. The port network is being modernized with serious capital. And yet, when logistic professionals are asked which emerging markets they are watching, the conversation gravitates to India, Vietnam, Indonesia. Brazil is mentioned as an afterthought, if at all. That is the opportunity. The markets that reward the most are the ones that are genuinely underappreciated, and not the one which is already on every pitch deck and every conference panel. Brazil is not on enough pitch deck, not yet. The smartest logistic operators and investors in this market will not be the ones who discovered Brazil in 2030. They will be the ones who are already there when this video was made. Thank you for watching till the end. See you next week.